And welcome back to the show this morning. It's 6:47 on this Friday Eve edition. Now, you made it. The week's almost over. Almost a Friday. Wrapping up. Long weekend coming up. And, of course, just going to enjoy yourself. I don't know how the weather's going to be here. Have you gotten a weather update for this weekend?
It's May. It's going to be hot and sticky.
Not rainy, though.
No.
Okay. We'll see. No rainy. It's just be hot and sticky.
Just hot and sticky.
And look, it only gets worse between now and August, right? We move from hot and sticky to hotter than hell. So
I'm living for October.
Exactly. Mike lives up in Maryland where it's like, nice, temperate. What is up there right now, Mike? About 70 degrees?
Today, it's been nice the last few days, but by the time we get to June, July, August, we're going to have Houston weather.
Really?
Hot and humid. Yeah. 90s and high humidity and thunderstorms in the afternoons.
No, there you go. All right, so don't move to Maryland.
But then we get fall.
Yeah, you get fall. But the difference is we go from summer to spring. Y'all go from summer to like snow and have to shovel driveways and all that stuff. So
it gives me lots of reasons to complain all year round.
Exactly. Let's talk a little bit about one thing happening here. I think is interesting is that you mentioned in the last segment we're talking a little bit about inflation expectations, and inflation expectations have been declining here recently. And that's interesting because that's deflationary. And, of course, one of the biggest fears of the Fed is deflation. Deflation versus inflation. When you have deflation, it's a very hard cycle to break because once prices come down, individuals will stop consuming at some point, expecting prices to continue to fall. I think it's interesting. We saw kind of the same effect happening in the housing market. Is that when interest rates popped up to over 3%, the housing market came to a standstill because home buyers do two things. One, they go, well, I can't afford the higher payment because I'm living paycheck to paycheck, which we know is a big problem in the United States. But the other is that, we've trained an entire generation of people now to be bargain shoppers for lower rates. And so when rates pop up, they go, I'll just wait. Rates will come back down in a couple months, then I'll buy the house. And so this is the problem is the Fed has been trying to get, inflation up above 2%, which would suggest that interest rates would need to be higher on the 10-year Treasury to correspond with higher rates of inflation. But the big problem for the Fed is, and a big problem for a lot of the bond, people expecting rates to go up has been this deflationary pressure on the economy that keeps pushing both inflation and interest rates to lower rates.
Yeah, but Lance, let's call deflation what it is, and it's a boogeyman. The last time we had deflation in this country was during the Great Depression, almost 100 years ago.
Yep.
We've had inflation, sometimes small inflation, 1%, 0.5%, 1.5%, and we've had double-digit inflation. Mm-hmm. But if you look at inflation over the last 10 years, it's been in a relatively tight range, close enough to 2% to their target. So when the Fed starts talking about lack of inflation expectations, we have had, broadly speaking, a very stable rate of 1.5% to 2% inflation,
but
as measured by the government.
I was going to say, because when I take a look at things, and I think this is for most Americans, whenever you ask somebody on the street about what inflation is, and you go, what do you think about CPI? I was like, even the average person figures out that the CPI measure is not realistic. When gasoline 10 years ago was $1.50 a barrel, now it's almost $3.50 a gallon on gasoline. Rental rates are at all-time highs. Home prices have risen markedly over the last decade. Asset prices are at an all-time high. Valuations are back, second highest level in history. And we don't measure asset valuation as part of inflation. We've had a massive inflation in asset prices, not just stocks, but everything, right? Whether it's real estate or private equity. We have 336 companies that are private right now, valued at over $1 billion. If there's not inflation in the economy, and this I think, and not to even mention tuition, healthcare costs, et cetera, I think most people realize there's a lot higher rate of inflation than just 2%.
Yeah, and we've written about this a lot. Just a month or two ago, we just looked at housing. And it used to be that they would look at house prices as part of the inflation index, and they didn't like what they saw there, so they changed it to rents, which are a much slower growing prices. And if you just put in housing prices and take out rent using very popular broad indexes, inflation is well over 2%.
Right.
And you can do that for we were looking at cars, Lance, and what was it? I think it was a GM or Ford that they've been making the same car for 20 years.
Right.
The price of that car, which is very similar. Yes, there's some new. It's a safer car. It looks a little nicer. Probably has a few extra gadgets on it. But the price had doubled from 2000 to today. Yet, if you look at the car index in the CPI, it's gone up very minimally.
Right. And this is because of this whole idea of hedonic pricing, which is, well, the car is safer. It's got more gadgets in it, even though it's still 4 tires and an engine and a transmission and a body and 4 seats. It's got all this extra stuff, which means it's got more value because of these other things than what the price actually displays. And again, this is all that manipulation. And this is for one reason and one reason only. We've been messing with CPI for the last 20 years in order to suppress the rate of inflation, in order to pay out less in Social Security payments, right? Because it's such a big part of what the requirements are of government spending. And this has been a specific tack. And the point of any measure, and this is why when you really take a look at any government measure, you got to really, look at it. You can't look at it at face value and say, oh, that's really what it means. Because many of these numbers have been massaged and manipulated and adjusted to achieve a specific target. And when you start manipulating an indicator to achieve a specific outcome, excuse me, I had to sneeze. To achieve a specific outcome, it no longer really has the representation of what we should be using it for in terms of making, monetary or fiscal policy decisions.
Right, and it's not just Social Security, Lance. Most employers give raises based on the rate, on the approximate rate of inflation.
Yep.
So if most employers, not just the U.S. government, but a lot of employers are giving, say, 2% raises, and CPI is 2%, well, they're keeping up with inflation. Their wages are increasing, but their purchasing power is staying the same. But if that rate of inflation is really 5%, not 2%, but they're only getting a 2% raise, they're falling behind.
Yep.
And that's why Donald Trump won the election. That's why Bernie Sanders and AOC and Elizabeth Warren are so popular, because people are getting crunched, especially the middle and lower classes. And they want something different, and they can't explain it. They don't understand why, but they know that their purchasing power is less today than it was yesterday.
Well, and I think it's interesting. If you look at all these websites, we talk about on the show all the time is study after study after study. 60% of Americans can't make ends meet every month. We run a study that shows that basically the average household on a per capita basis has about a $3,000 annual deficit relative to their cost of living, which is why households have so much credit card debt. They're just trying to make ends meet. And then there's all these articles out, well, if you want to be rich, just save more. There's a reason that people can't save. And to your point is simply they are barely able to just keep their standard of living together because of lack of wage growth, et cetera, over time.
That's right. That's right. And you don't realize it. It creeps up on you. And, there's a lot of explanations for why the middle and lower classes are falling behind. But far and away, this is the biggest one. And very few people understand it. It gets very technical. The understanding what the BLS and other government data collectors do to their data is very hard to understand. Some of the hedonics do make some sense. Cars are safer. They get better gas mileage. A car of the same price is actually worth more than it was 20 years ago because of those enhancements. But let's be honest, they are not keeping the correct inflation rate. And that's not just a statistic that the market plays around with. That's something that affects everyone.
Right, absolutely. the markets really haven't taken a whole lot into what's happening with tariffs and with this trade war, which is about to restart again on June the 1st when these tariffs are reinstated. And I thought it was interesting, just over the night, Japan, Korea, others have also joined in with the U.S. against Huawei, which is the Chinese telecommunications company, and boycotting their products, which is going to only wind up. This is a major company inside of China. It's one of their largest corporations. It's the Microsoft or it's the Apple of China, right? And, I can't imagine that this doesn't really put China on the defense in terms of fighting against tariffs and trade with Donald Trump. What do you think?
Absolutely. And now we know why talks broke down. It's all over technology, and it's all over this cyber warfare and spying and the way that materials and parts used in all our products are potentially have spying type capabilities. So this just, I think what we've seen over the last week or 2, 3 weeks sheds a lot of light on why these trade talks are going to be so hard. This isn't about soybeans and cars. This is about much bigger things here, Lance.
Absolutely. So pay attention to all this, because this is going to matter. And while it hasn't mattered to the markets yet, it doesn't mean it won't matter. So definitely pay attention to this. Be sure to get by the website. Like I said, Michael Lebowitz's new article is out called The Corporate Management Line, talking about corporate debt. I've got a follow-up article coming out on Monday relating to basically Jerome Powell's "This is the subprime contained moment." That's coming out on Monday. Also, the 10 illustrated truths about investing in markets on the website now as well. So be sure and get by there. While you're there, register for the upcoming newsletter. That'll be out this weekend. And if you have any questions or comments, let us know what we can do to help. Also get registered for upcoming class on May the 29th, next Wednesday, talking about Social Security. So all that's on the website. Just about everything you need to be a successful investor on the website now, realinvestmentadvice.com. Also check out riapro.net. If you're an individual do-it-yourself investor, we have all the data there for you. Sample portfolios, long, short, idea list. It's all there at the website, riapro.net. Have a great weekend and enjoy your Memorial Day weekend. And we'll see you back here on Monday for the next edition of the Lance Roberts Show. See you then.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.